All right, so we're going to talk about how the transactions affect the counting equation. So you'll notice here, I'm going to use this example on the screen here. Let me make it a little bit bigger so you can see it. Okay. And so the first transaction says Regina Delgado, the owner, invested $25,000 in cash. They already kind of have this explained up on the top, but I'm going to go ahead and record this one as well. You want to make sure that every time you record a transaction that it affects at least two accounts. Okay, so I'm going to go ahead and give you a hint. Anytime you say you're dealing with received cash, wrote a check, anything like that, you're talking automatically about cash and bank. And in this one, the money is coming in the business, so we're going to add $25,000 to cash and bank. And since the owner, let me make this a little bit easier so we can see it. There we go. And since the owner is the one investing it, it's automatically going to go into capital for $25,000. Okay, another increase. All right. So we have our assets equals liabilities plus owner's equity, making it $25,000 added on each side. Okay. So the next transaction says we bought a car wash equipment with cash for $12,000. Again, already we see the with cash. That means that we're going to be dealing with cash and bank, and since we bought the item, it's going to be a subtracted $12,000. Okay, and then you want to look at what you bought. Well, we bought car wash equipment. So car wash equipment is going to increase by $12,000. Okay? Again, on the same side of the equation, but we subtracted and added, which keeps our equation balanced. Okay, the third transaction, purchased on account $2,500 of office equipment. Okay, another key phrase in your transactions that you're going to see throughout this entire course is on account. Okay, on account means that you are either going to be dealing with accounts payable or accounts receivable, because that means something was done on credit and is going to be paid for later. This is purchased on account. Okay, so we purchased it, so we're talking about accounts payable. So we're going to increase our debt by $2,500. Okay, so we're going to increase accounts payable by $2,500 because we're going to pay that later. And then you have to look at what we bought. We bought office equipment, so we're going to add $2,500 to office equipment. Okay, the next thing you see is we wrote a check for monthly rent of $800. Okay, wrote a check. Automatically talking about cash and bank. Okay, and when wrote a check, it means it's coming out, so we're going to minus $800. Okay, so rent is one of those intangible things that we can't resell later on to make money. So it can't be an asset, okay? Or it can't be accounts payable because that's not a debt we're paying off. It's just a bill. So since it's a bill or an expense, it's an intangible, it's going to have a negative effect on our capital. So it's going to be minus $800 from your capital. All right, on number 5, it says we received cash for services performed. Okay, so we received cash. That automatically is cash and bank, so we're going to increase cash and bank by $1,000. Okay, so the services performed, we're automatically talking about revenue. Okay, so this is some more money that people have paid for us. So we're going to increase our capital by $1,000 whenever it's revenue. All right, number 6, the owner withdrew $600 cash from the business for personal use, making sure they're following that business entity. That's very good. Okay, so we've got automatically withdrawing cash, so that's a minus $600 from cash and bank. And since we're removing it from the business, we're not selling anything or anything like that, it's just going to be a minus from capital that the owner's taking out. Okay, which when you own your own business, you can do that. All right, so now we said purchased a desk for $1,000. We're paying $200 in cash now, and we're agreeing to pay the balance in 800 days. So that's that on account we're talking about. So we know we paid $200 in cash, so we're going to minus $200. And this is going to be one of the transactions where we actually affect 3 different accounts. Okay, so we paid $200 in cash. We bought a desk, that's office furniture. So that's this column right here. So we are going to increase that by $1,000 because the desk was $1,000. Okay, and then we still owe $800 on it, so we're increasing our debt of $800. Whoops, excuse me, $800, not $8,000. Okay, so again, if you look at your equation, assets, which these two are your assets, you take 1,000 minus 200 equals liabilities, 800. So the transaction's still balanced. Okay, and if you don't understand that, by all means, please email me. Okay, so again, we got provided services worth 600 on account. So again, we're talking about either accounts receivable or accounts payable. Since this is something that we provided for somebody, so somebody owes us money, we're going to receive it. Whoops, and I need another row here. Insert row below. Okay, there we go. Then that means we're going to increase accounts receivable. So that's this column right here. So I'm going to put 600 here. And since it's for services, that's our revenue. So I'm going to increase this by 600 here. Again, please refer to the transaction examples if you need any help. And if you have any more questions, let me know.